Hello, folks. Hey, I bet you did not know that your clients can effectively be paying insurance companies anywhere from 3% to 20% interest effectively without those clients knowing it. Now, what the heck do I mean by that? Let's step back for a second. Here's a question. Now, let's say that you have something that you have to pay for, and you have an option of, do you pay $1,200 per year for this thing? Or do you pay $200 per month for this thing? It's the same thing. Do you pay $1,200 per year or $200 per month? Obviously, most of us are going to pay $1,200 per year, right? Why? Because if you pay $200 per month, then heck, that's $2,400 per year. Nobody would do that. Let's take this a step further. Had you rather pay $1,200 a year for something or $150 a month? Most of us would choose $1,200 per year. Now, here's a question. Would you rather pay $1,200 per year for something or $105 per month? Now, this is where it gets a little more complicated, right? Well, $105 per month, effectively, how much more am I paying over that year's period of time for this thing? And the way that finance works is, what is the effective interest rate that you're having to pay on that 1 year loan, so to speak, over that year's period of time? Because we all know that if you had a choice between $1,200 per year and just $100 per month, most people would choose $100 per month because there's effectively no interest rate attached to that $100 per month. 100 times 12 equals $1,200. This is where I get into modal premiums with life insurance. Let's look at an example here, and I'm going to show you some pretty compelling numbers here. I haven't run these numbers yet, but I'll just tell you without even looking at them that they're pretty compelling here. So this is an illustration that I ran on myself. $1 million, let's see, preferred, age 43, and protective came up number one. By the way, folks, this is iPipeline. You have this technology with CG Financial Group. And by the way, you also have protective with CG Financial Group, which is one of the most glorious insurance companies on earth because they are always within the top 2, 3, 4, 5 of GUL and term illustrations when I run them on this ledger. But I digress. So here is the annual premium. If I were to pay an annual premium of $1,444 per year, boom, I'm done for the next year, right? Now, conversely, the insurance company says, or if you choose a modal premium, it's going to be $148 per month. Now, folks that have been in the business for a while, and I'm gonna show you true time value of money interest rates, effective interest rates on a couple of these modal premiums. But many of us know how this goes. $148 times 12, it's going to equal more than the annual premium. What does that equal? $1,776. 1776, America, right? $1,776. Now, folks, $32 may not sound like a whole lot, but I will tell you from an effective interest rate standpoint, it's actually pretty substantial. And think about this. On this 30-year term, the insurance company is effectively giving that client an annual loan that they pay off over 12 months, 30 years, right? And not one for 30 years, but it resets year 2, resets year 3. Now, the question that maybe some of the very financial minded folks may have is, what kind of effective interest rate is that? All right, so let's punch this into my 17, what is this? This is 17B2, which is a great calculator, by the way. $1,744. So that is effectively what the loan amount is, effectively, not technically. The loan that the insurance company has given a client to pay off over a year to the tune of $148. Now, over a year's period of time, what is the interest rate on that? Over a year's period of time, that interest rate is 4.42%. And by the way, we're going to get into the semi-annual mode here. Look at that. But 4.42%. So in a world where interest rates are low, the 10-year treasury is below 1.3%. Your clients aren't earning anything on their money. Effectively, they're being charged, 4.42%, right? So that's a conversation piece to have with your clients. Let's look at the semi-annual mode here. So let's go to 2 per year. All right, so over 1 year, the client is going to pay off the $1,744 loan with 2 payments to the tune of $907. Folks, this is a 16.72% effective interest rate that your clients are paying by not choosing that annual option, by effectively taking that loan from the insurance company and paying $907 twice over that year's period of time. Of course, this is how finance works. This is how the time value of money works. And by the way, I mention a lot that the average yield for the average insurance company in America today is around 4.5%. So I think that you'll find, especially with the monthly modes, that it's no coincidence that that interest rate that the clients are charged, effectively, interest rate, is around 4.5% many times. Of course, it gets a little crazier with some of the more sparse modes like semi-annual. Why? Because there's other stuff embedded in there like lapse assumptions as well. But that's a conversation piece to your clients to have with your clients, because I bet they do not know, a lot like withholding with the IRS, I bet they do not know that they are effectively giving insurance companies pretty good interest rate on the loan that the insurance companies are giving to those clients. Not literally, but effectively.